Good afternoon. I'm Jim Spencer. I am the Executive Director for the Bluefield, West Virginia Economic Development Authority, and glad that you're here with us. We hope you all had a good Thanksgiving and looking forward to Christmas upcoming. One of the things I'm passionate about is you could be the world's best chef in our food truck incubator. You could be the world's best plumber or whatever it may be, but you could still fail at business. And one of the key components that I think for the reason for failure is the lack of education. And a lot of times that education is in financial matters, could be in marketing, it could be in inventory and different things like that. And we try to combat that through education. So we're proud today to partner with Ms. Carol and First Microloan. She'll tell you a little bit more about their program. And we're excited to have them here for two sessions. One is understanding your financial statements, and then later on, there'll be one on show me the money. What happens if the bank turns you down? And Ms. Carol's going to talk about that. So thank you for being here. If there's anything we can do to help for whatever stage in entrepreneurship you're in, we have an online entrepreneurs boot camp and other things that we would be glad to provide services to you. So without further ado, I'll turn it over to Ms. Carol. Thank you.
Thank you, Jim. Thank you, everyone, for coming out and joining us via Zoom. I'm very pleased to be back down in Bluefield. It's probably been a decade since I've been here. Came down on 77 just as I topped that last hill. The sun was shining, so I knew it was going to be a good day. I am from First Microloan of West Virginia. We are an SBA lender in the state of West Virginia through this microloan program, which basically means we can loan up to $50,000 with SBA money. Unfortunately, we don't cover Bluefield County, but we do cover Raleigh County. So we do have other partners, so I can help you out when the time is right or when you need somebody to help with funding. But today I'm going to start off with talking about financial statements. And I have to admit that I'm a recovering accountant. My main job prior to this one was accounting. So please stop me, ask any questions. If we don't get through the whole presentation, but we answer every question that you have, I think that's a positive. I don't know what everybody's level of expertise is, if you are in business now, or if you're thinking about being in business. So we'll try to cover a little bit of everything. So I'll jump right in. Like I said, please stop me if you have any questions. And hopefully I can get there we go. If you're in business and have been in business for a while, you've probably gone through the year-end tax report where you have to gather up all your data, and a lot of people wait and see, did I make money or I didn't make money? So the understanding financial statements is to help you throughout the year know where your business is at. A lot of people think if I have money in the cash drawer, I'm doing okay, but that might not tell the whole picture. And I'm not going to go into all the nitty-gritty details with accounting, generally accepted accounting principles, double entry, tax accounting. That's not what we're here for. So basically, financial statements are a way to help you understand what's going on with your business. There's money in, money out. There's other components of how that gets accounted for, how that's reported, and what that can mean to you. We're going to start off with assets. Assets are simply everything that you own. Cash is king. That's what's called a current asset. Pretty much everybody in business has some form of cash. It might be actual hard dollar cash, dollar bills, or it might be just money in the bank. Another type of asset is accounts receivable. Now, not every business has accounts receivable. If you're in business, say you have an auto repair shop and you have the pizza delivery company next to you has you service their trucks, do the oil changes, and rotate your tires, and you have them pay you once a month instead of every time they bring one of the vehicles in. So as soon as you finish one of those vehicles and send them the bill, that's an accounts receivable to you because they owe you the money, but you haven't collected it yet. Other types of assets, you have inventory, whether it might be inventory for resale or supplies that are used to manufacture something that you in turn sell. Prepaid expenses, we don't see this very often in smaller businesses, but that is something that you have paid in advance for. Maybe you pay 3 months in advance for your rent when you sign a new lease. Well, that would be prepaid because you're paying in advance for it and you haven't used that month's rent yet. Other types of assets are items that are fixed, that are not likely to be moving, like inventory or cash. These are typically land and equipment. Now, on the other side, we just talked about some of the things that you actually have in your business. And now we're going to talk about liabilities, which are debts. Debts are money that you owe out. Where we talked about maybe you have a customer that you allow them to have like a little charge account with you where you in turn invoice them as the jobs are completed. Maybe you have somebody that does that for you, whether, well, we can say you're the auto repair store and you have a Napa store right next to you. Maybe they allow you to have a charge account, and every time you go there to buy your oil filters or whatever, that they just keep it on your tab and then once a month send you the bill. That is something that you as the business now owe, and that's what is a liability. And that's also called accounts payable, because accounts payable is a current liability. Current liabilities means that's something that you're going to have to use your cash for to pay fairly soon. Employment taxes, those are current liabilities. You may only pay them once a year for some things, like maybe the federal unemployment tax. Maybe you have to pay every week if you have a large payroll and have the Social Security and federal withholding tax to submit. Maybe your state withholding, you have to submit that every month. Other types of liabilities are longer term liabilities, something that's going to be paid out over a period of maybe a year or several years. This is where your bank notes are showing at. And then basically everything that's left is your owner's equity. And you hear the accountants talk about sometimes the residual. So you take your assets, everything that you own for the business, minus everything that you're going to have to pay out for your liabilities. And what's left is owner's equity. Sometimes it's positive, sometimes it's negative, depending on where things fluctuate. And this is just a simplified version of what we just talked about. Everything you own minus what you owe is your net worth. Or what you own plus what you owe plus your net worth. It equals, either way you do this calculation, it comes out to the same thing. So we just talked about some of the components of a financial statement. So how do you put those together? So a balance sheet is also called a statement of financial position. It's also called a statement of assets and liabilities. It means the exact same thing. And the balance sheet is as of a particular time. It might be as of yesterday. And if you run it today, it's going to be different than it was yesterday. So it's just at one set fixed point in time. If you go for any type of financing, whether it's bank financing or a non-traditional lender, which is what my organization is called, they're going to ask you for a financial statement. You don't have to have an accountant prepared, but there has to be key components in that. And most of them will give you a template if you don't have an accountant that you can fill in. But they're going to go through what your assets are, what you own, and your liabilities, what you owe. And based on this, it's going to give the reader of the financial statement a good gauge of your business, what your business activities have been, what the value of your business is. It's very important that you do have some assets. And I know a lot of times when you're starting out, it seems like you're always running behind. You need more money. You don't have the money, but you may have money out there that's owed to you and money that you owe out, but you don't have the cash on hand to take care of it. That's going to be reflected on your financial statement. Here's just an example of a balance sheet. We have the current assets. Things are immediately available. You have cash, accounts receivable, and inventories. Then you have fixed assets, which are longer term, which you have your equipment, furnishing and fixtures for your office. which brings you up to your total assets. And in this case, there were no current liabilities, nothing that's immediately payable. You have your long-term payable, which is probably a bank note of some kind. So you have assets of $64,000. You owe debt of $47,000, which brings your equity, the owner's equity, of $17,000. So your assets equal the liabilities and stockholders' equity. Moving on. So we covered the balance sheet. Now we're going to go to the other companion financial statement, which is the income statement, the statement of profit and loss, or the statement of income and expenses. All the same thing, just different terminology for it. We always start off with your sales. This is sales that you've made, whether it is sales that you've collected in cash or total sales, which include maybe the accounts receivable that you had for your customer. And we always net that out if you'd had any kind of a return or a discount that you had given your customer. From your sales, then we are going to deduct the cost of goods sold. That is your cost, whether it's your labor or your materials to directly prepare that sale that you had. So keeping with our example of the auto parts store or the auto mechanic. So as he said, he sold a set of tires. They're small tires. So he said $400 set of tires. So his cost of goods sold is going to be the cost of those tires. Keep things easy. Say it cost him $50 for those tires. He also had his mechanic that he used to change those tires out, and say that was $20. So he has $400. No, I forget what I said now. $100 in sales minus $50 for the tire minus the $20 for the labor. So that gives him his net margin on that. And then we'll come into that a little bit later. So right now we're just trying to capture everything that's being used to create that sale. And the gross profit is just cost of goods sold from your net sales. Doesn't include any of your operating expenses. It's not going to count your rent or your utilities. And this is important a lot of times in businesses because the financial institution wants to know that you're pricing your product correctly, because you always want to make a profit at the end. So you're going to have to cover your cost to produce whatever item you're producing. Plus, you're going to have enough of a markup that it's going to cover your operating expenses. And there are all kinds of industry standards and industry guides out there that can kind of give you a benchmark. Say if you're a restaurant, you should be making a 35% gross profit margin, and that's before your operating expenses. Or if you're very heavy into the service industry, you may not have much of a cost of goods sold item at all, and maybe yours is a 90%. But that just helps the bank or the other lender tell that you are marking up your sale and capturing the right cost that you should be capturing. So then we go into what are the expenses of your business. And that is basically anything else that you are paying out to help support your business, to help keep your business running. Advertising cost, interest on a bank loan, interest on your Snap-on tool loan in case of our auto mechanic there, any general supplies, real estate taxes, your monthly rent, all associated costs with payroll, meetings and reception costs, travel, entertainment, utilities, pretty much you name it, as long as it's used for the business. So then once we have our total expenses calculated, we deduct those from your gross profit, and that becomes your net income before taxes. Net income is the amount of money the business has earned after paying taxes to the government if you have a profit, or your state and local taxes. Now, a lot of businesses nowadays, they're not set up as corporations, they go as LLCs. So the tax might be at the personal level, not so much at the business level. And again, income statement has the multiple names, profit and loss. It just records all revenue and expenses for a given period of time. We talked about the balance sheet. It was as of XYZ date. Income statement is for maybe a 12-month period or a 6-month period, whatever data you're trying to capture. Typically, people use a calendar year and they run their business on a calendar year. Some retail stores, because of how Christmas falls in there, sometimes they go with a different year. It doesn't matter what 12-month period you use, just as long as there's a start and stopping point and you're consistent with that, and that ties in with your tax reporting. So the income statement, when you have it all filled out, and you want to make sure that you don't lump everything in there together, because you need to be able to see advertising cost. So when you compare one year to the next, you can see, well, I've spent a lot more on advertising this year. Maybe that's what helped me have a lot more income this year than I did last year. It helps you with what's called a side-by-side comparison, comparing one year to the next on line items to see what went up, what went down, what the effect of one versus the other was on your actual bottom line. And a lot of times when you're looking, say you're on a calendar year basis and you're not keeping your financial statements, but you just wait till you get your tax return prepared at the end of the year. And it's easy to forget something that happened 10 months ago. And you look at your tax return and thought, wow, man, I thought the business did a lot better than that. What happened? So you go down through and, oh yes, I remember that big expenditure I had back in February. So by keeping a financial statement, it keeps all that a little more forefront in your mind to help you gauge what you're actually doing better. Here's just an example of an income statement. This one just shows the activity every month, which is good because then you can tell which month is a little more profitable for you than others. It also helps determine the seasonality of your business, help gauge maybe when you need to hire employees, or unfortunately, maybe you need to let them lay off for a month or so because the business is a little bit slower in some of those time frames. This can be very helpful as well because some lenders do allow you to modify your loan payments based on seasonality. If winter is a terrible month for your businesses, they may allow you to go to a 9-month payment plan that you're making those 9 payments in the months that you're super busy, and you can skip the payments in the months that you're not, or go to a lesser payment. So it's really important to be aware that if you can put a monthly income statement together. A year-end income statement is just as good, but there's some components that you might miss if you don't do it every month. Banks also like to see cash flow analysis. This is just a little bit like an income statement, but it just focuses on the cash in and the cash out. You may be paying, say you pay a loan payment. Only that interest is going to be shown on the income statement because interest is an expense. The principal repayment just decreases the liability over on your balance sheet. So when you do the cash flow, it's going to show you both the principal and the interest that you paid out because it's just, like it says, it's cash flow. Where did the cash come in from and where did it go out? One thing with cash flow is it helps identify too much inventory. And I actually have a customer that had too much inventory. He kept finding good deals and he was a retail store and he kept buying. He had the money, so he kept buying. He found really good deals, items that would sell. And pretty soon his store was full and he took on a storage building and the storage building was full. And he came down to the end of the year and realized, I don't have any cash left. I've got all this inventory here. I need to move my inventory. I need to hire an employee. Well, he wasn't keeping track until the end of the year for his tax return. So he didn't realize, even though he saw his inventory, he didn't realize how much money he had tied up in the inventory. So then he got into, I need to sell the inventory so I can have cash to hire my employee. But I need my employee to help me sell the inventory so I can generate the cash. So he was in one of those circular chicken and the egg type thing. So unfortunately, he had to go get a bank loan. which gave him the cash to hire the employees so that he could sell the inventory to repay the loan and to move on. But he's now keeping his track a little better on his finances. He's not doing the full blown deal, but he has stepped up what he's tracking so that he's aware of, maybe I only need 50% of the inventory that I used to have because I can get it in fast and it helps replenish itself. I'm not tying up all my cash. I'm able to move forward. And one good thing about using some of the various accounting softwares, and I have to admit that I have the QuickBooks as one of my favorite ones, it will generate all these reports for you. You don't have to create them. You just have to do some basic identifiers when you put information in, like you write a check, you have to make sure you tell it what kind of an expense it is that you're using that money for. And then at the end of the day, you can hit a button and it'll give you your report. It's going to track your expenses for you. Just some tidbits about accounts receivable. The larger, more advanced your business is, the more likely you're going to have accounts receivable. If you're running a restaurant, you're probably not going to have any accounts receivable at all. A lot of the small industries, especially custom work, does have some credit components where they offer credit to their customers. While you're recording those as a sale, and they're going to be reflected as a sale on your income statement, you're not going to be able to do anything with that sale until you actually have turned it into cash. So the accounts receivable goal is be nice to your customer. They have asked for the credit, they're credit worthy, and you feel comfortable with letting them do the credit. But you can't let them just carry that balance forever, because at some point in time, you're going to need their cash to pay for something else. So collect those receivables. Don't let them go by the wayside. Just summary again. Just because you have cash in the cash drawer doesn't mean you've generated a profit. And the profit is the difference between your total revenue and your total expenses. Just because the cash in the drawer is there, that doesn't necessarily mean that's all yours. One of the biggest drawbacks is the sales tax issue. A lot of retail stores, the money goes into the same checking account or goes into the same cash drawer at the end of the month, and you have to pay the sales tax to the state of West Virginia. You need to make sure you still have the cash in the drawer or in the bank somewhere sitting there so you can turn that into the state. With the sales tax, you're just temporarily holding that for the state. You've collected it from your customer, you're holding it, and then you're going to pay it back into the state. Make sure you don't use that money thinking it's yours, because if you can't pay your sales tax, eventually they're going to come after you, put a lien on your property, or hit you up. So you want to make sure that you realize just because there's cash in the drawer, it's not all yours. And again, you can be forced to close because you're running out of cash. Even though you maybe have generated a profit, you might be cash poor. A lot of businesses starting up, there's a lot of expenses. There's a lot of things that you have to do to get the business back on its feet. A lot of times people try to use credit cards. They try to use money that they've saved up. Sometimes that's not the best thing you can do for your business. Sometimes it is best to go into debt, get a small loan, to then let you get to where you need to be quicker, and then you can pay that back slowly over time while you do generate cash with your business that's going to allow you to do a little more. So here's just a flow chart that talks a little bit about cash, how it comes in, how it goes out. There are some spots where they call leakage, theft, or just bad decisions. Inventory is one where inventory can be damaged. Maybe it's left out in the weather and it wasn't supposed to be, and it's been destroyed. Well, that is an expense of the business. Unfortunately, it's going to have to cost you money to replace that so you can sell. Inventory, if you have it on the shelf in a retail environment, it may walk out the door without you knowing about it. So you've got a little bit of theft going on there. You might have leakage with accounts receivable. Maybe the auto body shop, again, you'd have a customer at the pizza shop and they brought 5 of their vehicles in, you serviced them, you gave them the invoice, and they close up and they go out of business. They don't have the money to pay you. So then you've got those factors in as well, things that are beyond your control. Valuing accounts receivable, this is very important when you go to get financing. Banks will sometimes loan you money based on the accounts receivable that you have. If you, or maybe a construction company or something, you have a little bit larger receivables, but the bank is not going to give you dollar for dollar. If you have $1,000 in receivable, the bank only might give you 25% of that as a loan, because it balances the risk to them and against the risk that that company's going to go out of business and not pay you. So what a bank does is they value your accounts receivable. They look at it, how old it is, who owes you the money, and they figure out what the probability of collecting on that money to determine what the value of your receivables may be. So just to reinforce some of the things that we talked about, cash flow versus profit and loss. They're not exactly the same thing, they're close. But if you're on a cash basis, you're only paying attention to cash when it hits your hand and cash when it goes out of your hand. If you're talking in accrual counting, here I go again with these terms here, but accrual counting is where you count everything. You count as soon as you let that customer charge his tires, you count that as a sale, even though you don't have the cash yet. Or if your supplier lets you buy on credit and you've purchased those tires, you count that as the expense, even though you haven't paid for it yet. So with that system, you just don't have money in, money out, but you have receivables and payables. So instead of accounting for 2 things, you count for 4 things. At the end of the day, you're going to get close to the same amount. Your bottom line profit should be very close to the same, regardless of which system you're on. You need to follow the cycle of your business, though, and keep consistent with whatever reporting period you're using. On a cash flow statement, they do look at changes in inventory. Instead of saying, okay, I put $100 in, I took $100 out, they're just going to say, okay, here is your beginning inventory, here's your ending inventory, what has been the fluctuation? So if you put $100 in and put $100 out, fluctuation is actually going to be 0, but your actual cash has 100 in and 100 out. So there's just different ways of reporting it, recording it. And on a cash flow, when you have capital expenditures, and capital expenditures are when you've actually bought something for your business that's going to stay with the business. Say you bought a copy machine. That, when you're reporting just on cash, that's not an expenditure because that machine is going to be staying with the business. It's going to be called a fixed asset. So your cash doesn't really show that you have an expenditure out because it goes to the value of your business. And again, as I mentioned earlier, when your principal repayment on your loan, now on your expense side, it's going to be the interest that was part of that payment. But the principal part's going to go over to reduce your larger debt. And we won't talk about depreciation. That could be a whole day, a whole boring day in itself. So where we had earlier a income statement by month, you can also have a cash flow by month. Again, it just helps you determine the flow of your cash, where it's going. And ideally, you like to see more cash flows from operations than you do from the other 2 categories that are on here. Investing activities are good because that is money that's going into your business, whether it's equipment or inventory. And then financing activity is exactly what it sounds like. Getting a loan, paying a loan back, or maybe even paying back the owner of the business. And I mentioned a little bit earlier about how the banks like to look at your income statement or your profit and loss or revenue and expenses, however you want to call it. So they can look at it and say, well, you're a restaurant and you should be making a 35% profit margin. That's what's called a ratio analysis. And it just, how is my company doing? Sometimes it's easier to see the percentages than it is to see the dollars. Banks always look at both, but it's just being able to tell from a prior year or from industry standards where your business is at, how healthy it is, if you're going in the right direction. If you look at and your profits are increasing and your sales really aren't increasing, well, that means you've got a good handle on your expenses, that you're doing something right. Now, likewise, if your sales are decreasing and your expenses aren't changing, then maybe you need to mix something up. Maybe you're not reaching your customers, or maybe your customers are going to a competitor. There's just different things that this ratio analysis will bring up that you can look at to kind of gauge how your business is doing, where it needs to go, what areas need to focus. Standards for businesses, I forget which ones are available online, but there's a whole slew of them out there. And they even go down, say if you're a restaurant, well, they'd even allow you to drill down a little more, whether you're a food truck restaurant, whether you're a steakhouse restaurant, or whether you're a McDonald's restaurant. They all have different ratios, and there's all different ones to look at. If you've ever worked at a retail store, a Walmart or a Kroger, they're very fixated on how many sales go through that line. And there used to be little posters up by as you exited the store, that we reach so many sales an hour or so many customers an hour. Key metrics that they need to track, and they're very good about that. That helps them gauge the level of employees they need to have on hand at a particular time. The peak hours maybe are 10 to 2, so they have maybe an extra employee working there than they do from the 6 to 10 hour. It also helps you, what are your food costs? A lot of suppliers now for restaurants have different tools available when you purchase it. You can build your menu to determine what your profit margin is going to be on particular items. And that's key to know, because maybe you have a steak place and you have a 10-ounce ribeye and a 4-ounce filet mignon, and you run through these scenarios and you realize, well, I'm selling more ribeyes and I'm making more ribeyes than I am the filet mignon. Maybe I should take a look at my menu. Is there some things I can trim off my menu that maybe I need to maybe only offer as a special once a week instead of every day? How can I make more profit? Profit is the bottom line. You want money in your pocket. And then everybody knows the airline stories today that, you have to have every seat full. Cram them in there as much as you can. Movie would be the same place. You also might hear about liquidity. Banks want to know how liquid you are. This is, can you pay that short-term debt? If somebody walked in today and said, you owe me money, you said you were going to pay it 3 weeks ago, you don't pay, are you able to pull money out of your cash register and pay that debt when it is due? So some of the things that the bank will look at, their bank loves ratios, they love worksheets, they'll plug all your data in this big, massive computer system and spit all these numbers out. On an alternative lender side, which we don't have to go through everything that the bank does, some of these ratios are great, but when you're talking about small businesses, sometimes it really is not pertinent. If you're a small convenience store and they talk about inventory turns, how many times basically your complete inventory sells and you replenish it. That might not be super critical if you're the small convenience store. That's super critical if you're the neighborhood Walmart. So all this is in relation to the size of the business. Banks love working capital. That basically means your current assets, your accounts receivable and your cash, minus your current liabilities, typically would be your accounts payable and maybe payroll. They run some numbers on those. Then they massage them a little bit. Sometimes they put inventory in, sometimes they take inventory out. This is all to help build their data on you to make them feel comfortable that the business is valued, the business is operating, and that they feel comfortable in making the loan. And these items are maybe helpful for you as the business owner. They may not be. A lot of the software, accounting software that you might use for your business can kick these out. As a small business owner, I don't think that you would need to sit down and worry about this every day or every week, or maybe not even every year. Just kind of be aware that it's there, because if you do go for bank financing, that is an item that will pop up. They also talk about your debt to equity ratio. That basically means everything that you owe against what the value of the business is. And ideally, you would like to have positive equity. And they also want to look at your total debt to your total assets. Say you started a business and got a $10,000 bank loan, and that went to soft costs for the business. Maybe you had to get an attorney to help you set up the LLC, review your lease on the building, and all that money went to expenses. But right now you don't have any assets. Well, that's not going to look too good on the bank side, because there's big fat zero over here, and then there's $10,000 over here. But if that same $10,000 was maybe used for equipment, now you have $10,000 on your asset, what you own, versus your $10,000 payable. And in that case, even though it's a 1-to-1, it's still better than a 0 to 10. And operating ratios, they help you determine your profit in the business. That is what we had talked about a little bit earlier with your income statement, your profit and loss statement, where you have sales minus your cost of goods sold equals your gross margin. Gross margin can be also a percentage gross margin, or it can be a dollar gross margin, and that is called an operating ratio. And I mentioned earlier the inventory turns. That is what your cost into the inventory was versus what your average inventory is. And that might tell you that you turn your inventory 12 times a year, once a month. Depending on your business, that might be terrific. If you're a retail business and you turn your inventory over once a year or once a month, you might not be selling enough stuff, or you might have too much on hand. That can also go into play in if your inventory all comes from China, and say it takes 3 months to get here. Well, then you may need to have 3 months of inventory on hand, because it's going to take that long to replenish it. So there's just different methods that you can use the same ratio to determine information. Again, there's receivable turnover. If you allow somebody to buy on credit from you, how fast that's turned over into cash. Again, more inventory turnover. Banks love accounts receivable turnover, unless you have a large number of clients that are charging a lot. That's probably not too meaningful. If you do have a large accounts receivable balance, hopefully it's with multiple customers and they're all paying at different times of the month, so that you can keep that cash flowing in, instead of having all your cash hit on one day and then having to pay it all out the next day, because you have to wait till all your cash comes in to pay your suppliers. So then the profitability ratios, those are really good for your business, in that you know what your gross margin is, what your sales minus your direct cost, and also the various expenses, your operating expenses that you've had to pay out. Maybe you rent, and your rent is 2%, 2% of sales every year. And then all of a sudden your landlord comes in and says, everybody in the neighborhood's raising their rent, so I'm going to raise my rent. And all of a sudden now your rent's 5%. Well, if you're not making a lot of money, you're going to have to make up that from somewhere else. Is there another expense category that you can adjust? Are you going to have to raise your sales to a customer? You're going to have to adjust to fluctuate that somewhere, or are you just going to take the hit and have your profit go down? We talked about the profit margin a couple of times, your return on your assets, which is basically your bottom line net income divided by your total assets, the value of your business. Again, looking at your business in relation to what other businesses in your field are doing. Are you in line with them? Are you doing better than them? If so, great. Make sure you know what you're doing better than them so you can keep on doing it. If you're not, where is an area that maybe you need to focus on? Do you need to increase sales, decrease cost? Maybe your operating costs are too high. This is just in a little example. An appliance shop has a current ratio and the industry ratio is a little bit lower. Is that a good thing or a bad thing? In this case, it's a good thing. Ratios can be both ways. Sometimes if you're lower than the industry standard, that's a good thing. Sometimes if you're above the industry standard, that's a good thing. It just depends on what ratio you're looking at. Like if your profit is higher than the industry standard, that's a great thing. And on this case, it's looking at inventory. Sam's is his ratio is a little bit lower than the industry. And as it says that this could be good, but a sales slump, then that might be a problem for Sam because he's got things tied up. Sam's debt ratio is almost close to the industry median ratio. And again, it says that this may be okay. It just depends on what is going on with the business. If he needed to reach out and borrow additional money, the bank might come back and say, well, you're already a little bit high on your loans. We may not be able to advance additional money. Debt to net worth, that's just another ratio. Times interest earned, this is important for the bank because they're going to want to know that you're generating enough money to repay their loan. And you're not just going to repay the amount of money that you borrowed, that you've got interest on there. And they're very concerned that you're going to be able to pay the whole portion of that. When we talked about the inventory turnover, in this case, the industry average is 4, and Sam's only turning out 2. So that means maybe he's got too much inventory, or he's just not having enough sales to keep that moving through. And this can be a bad thing because maybe he borrowed money from the bank to buy that inventory. So the inventory isn't moving, so he's not generating the cash to repay the bank. It may not be a bad thing if he didn't have a loan against it, that it was already paid for and it's a high volume. Maybe he's an RV dealership or something like that. So each RV, he may sit on the lot for 12 months before he sells it. So there's different factors that can go into play on all these. Accounts receivable. Again, poor Sam. It takes him 50 days to collect on his receivable. So he lets somebody buy a cook stove, and they pay him in 50 days. Well, the industry says, well, most people are paying it in 19 days. You're letting these people go out 50 days, almost 2 months before they pay you back, which could be really bad if Sam has to pay his supplier in 30 days because he's not going to collect the money. He's going to have to pay it out. So he's going to be running short on cash. And if that keeps happening, eventually it's going to catch up to him. And again, on the other side of it, what Sam owes to his people, he's taken 59 days to pay. Well, that makes sense because he was taking 50 days to collect, so he's having to take another 59 before he can pay out. So his suppliers are going to say, well, why should I sell to you, Sam? You don't pay me quick enough. So everything links together. Again, just sales to assets, another thing that the banks really like to look at. Net profit on sales. This is very important. This is the bottom line profit ratio. Sam's generating 3% on every sales dollar. It's what's the amount left at the end of the day after he deducts all his expenses. And the industry median is 7.6%. So he's less than half. So he's somehow leaving money on the table, whether he's not charging his customers enough, or maybe his expenses are just too high. If Sam's happy with that, that's up to Sam. It's his business. But if he wants to be profitable and he wants the bank to look at him a little more favorably, maybe he needs to find a way to increase that. Profit on equity, that is the value of the business. Are you consistently being a positive return on your equity? That is very helpful if you're wanting to sell your business, because the new owner wants to make sure that this is profitable and that he's going to put all his money in buying this business, that he eventually will get something out on the other side of it. And this is just trending, putting things on a graph to help you see what's going on. Sometimes that's a little more easy to see something that jumps out at you. Again, we can see where, if you're not colorblind, we've got a red line, which is the industry, and blue, which is Sam's store. Sam was doing much better than the industry, and then bam, something happened. This will help Sam pinpoint, well, what happened in May? My supplier started charging me more and something happened, or a new customer opened up down the street, or I got sick and wasn't paying much attention to the business and was just letting the employees run it. There'll be all kinds of things that go into play here, and it just helps you pinpoint what's going on. See if the trend kept occurring, if it got worse, or it was getting better. So I blew through a lot of this really fast. Didn't want to bore you with all the accounting terms, but it is important that you do keep some kind of a financial record keeping system, and can go back and look at where you're at a point in time with your assets, your financial statements, and how profitable your business is, and are you keeping track of your expenses. It also helps at the end of the year when you go take your papers in, have your tax return done. Hopefully it could save you a little bit of money because you already have all this stuff compiled, and the tax preparer doesn't have to go through and do it. It also can help you, do you keep an eye on it and say, wow, I'm having a really great year, my profits are up. Maybe I need to go talk to the accountant before the end of the year because I don't want to owe so much in tax. So there's all kinds of different things you can keep track of with financial statements. Yeah. Any questions? Just want to go over a little bit my advertising plug here. I'm with First Microloan of West Virginia. I cover the southern half of the state. We have Tim James, he's the loan officer for the northern half of the state. We work a lot with Small Business Development Center. Would you like to come and say something? Nope. Okay, they're passed. We have somebody here in attendance today. Small Business Development Center in West Virginia helps businesses from day one with various activities. They have various training. They have coaches. Pretty much you have a question, if they can't get the answer, there's somebody on staff that can answer every question that you have. They can help hold your hand. They can give you pointers. They're a fabulous resource, often underutilized. But if you need assistance, you can contact me and I can hook you up with somebody. You contact them, and if you need help with financing, they know the directions to take. We always try to encourage people to go to bank financing first. And if that doesn't work out, then there's other alternative lenders in the state that are here that are supposed to work with you to help your business get started and to stay in business, because that's the ultimate goal, is more businesses in West Virginia. So thank you for your time today, and that should be all I've got.